Chris, when it comes to this European economy, what say you?
Oh, I think the recession's coming. It's on its way. Whether it's a Western recession or European recession. I mean, clearly what's happened is China's reopened. That's added a bit of a bid to the sort of global economy, particularly in Europe, as you say. It's got a lot of trade links with China. So yeah, I mean, the recession, the money's tight, and the ECB's getting it tighter. Banking conditions are reasonably tight. They're getting very tight in the States. And the rule of thumb is, and it pretty much always works, wherever the US goes, so Europe follows. So it's on its way.
Okay, so delayed, I think, Chris, is your point. But so that's how you feel, but then you're long equities. You upgraded from neutral. So what's that about?
Well, that's more of a sort of tactical call. I mean, I think what's happened is, I mean, we're in this weird kind of stock market, and central bankers basically are in sort of slightly schizophrenic. Do they deal with monetary policy issues or do they deal with financial stability issues? And whenever we get a blow up because they've tightened money too much, we get a blow up in the banks, or you had a blow up in the British pension system at the back end of last year. All of that reflects tight money, and they respond with financial stability tools and print money. So, you know, the reason we're overweight equities on a tactical short-term basis at the moment is basically because there's a lot of liquidity around and it's pushing the markets higher. You know, there's a lot of risk aversion, a lot of fear in mid-March, and it takes a while for that to come out of the system. I would say if you look beyond a couple of months, I would be bearish on equities, and in fact we are. We're underweight on a strategic longer-term basis.
What do you think is going to be the tipping point then that brings renewed pressure on the equity market? Is it going to be earnings? Is it going to be another bank failure? Like, what is it?
Well, we're working our way towards recession. It's quite interesting in the last month or two, the correlation of equities and bonds has changed. Last year, equities and bonds sold off together. In the last month or two, particularly since the banking crisis, bonds have rallied typically as equity have sold off. So, you know, that kind of correlation is telling you you're moving towards the point where the bond market's thinking more about recession dynamics. And that's natural, of course. With the banking crisis, you're going to tighten credit conditions further. You're going to accelerate the timing of the recession. So I think the key here is we need to price in recession into the stock market, into asset prices. We need to price in recession into earnings and a whole bunch of other asset classes, actually. So I think it's coming, and maybe you get some sort of big blow up with that. I mean, it's very difficult to know. But frankly, we're unwinding 12 years of financial repression and zero interest rates. The idea you can do it without any blow ups and any major problems, it's all manageable, is kind of sort of cloud cuckoo land, in my opinion.